Hey everyone, this is Sandeep. If you're someone who is not currently investing through tax advantaged investment vehicles like 401k or IRAs or the Roth versions of those, then this video is for you. Stay till the end and watch why you are missing out on a lot. Maybe you're not really sure if you will get any benefit out of it. Or maybe you're thinking that retirement is a long ways off, so I'll just take care of it some other time. Or you just plain think that this is all some sort of big government scam to take your money. Either ways, if you are putting this decision off, then you are basically leaving money on the table. And the more you delay this decision to invest in these tax advantaged investment options, the more money you are foregoing because of the power of compounding. So let me make a case for why investing using these tax advantaged options is beneficial to you, not only as a way to automatically save for retirement and not spend all the money you're making right now on things that you don't need, but even if you are reasonably well to do and you think you will have a good enough savings stashed around for your retirement, even then you should take advantage of these options. And that advantage comes from the simple fact that you get to defer the tax on a certain amount of your salary, and then you get to invest that amount and make money off of it over a period of years, and then give a share of those profits to the government and keep the rest for yourself. If you are not taking advantage of this right now, you're basically missing out on an opportunity to make money off of that loan essentially that the government is giving you today by not taxing you on that amount of money today. If you'd like to know more about exactly how this works, please go and check out my other video link here and down below, where I give a dollar by dollar comparison of what you'd make if you invest through a 401k versus if you don't invest through a 401k. Because allowing some amount of your salary to not be taxed today is almost like getting a free loan from the government, an interest-free loan from the government, where the government says, I'm not going to tax for this portion of the salary today, so you do whatever you want with that money right now. And which you would say that, okay, I'm not going to take the salary right now, I'm going to invest and grow that portion of the salary, which otherwise I would have just paid right now in taxes. Why don't you keep that money with me? I invest it and make money off of it, and then when I retire, I pay that and maybe a share of the profits that I made to the government. So it's almost like you're getting a free, interest-free loan from the government right now on a recurring annual basis, and you get to make money off of it. And the more time you have between now and your retirement to make money, the better off you'll be. So if you're not maxing out your 401k or a Roth or an IRA right now, or worse yet, you are not even contributing anything to those retirement options, then you're essentially saying no to a interest-free loan by the government to you right now, of which you can make money and save that over the long term. And on top of that, if your employer is offering a match for all of the dollars that you're contributing, or even a fraction of that, that's free money. So guys, in my last video, I talked about a 401k and who should and should not think about investing through a 401k, and also showed a dollar by dollar comparison of what you'd end up making through a 401k versus without one. In this video, I'll talk a little bit more about the other tax advantage options, such as IRAs, and also the Roth versions of both the 401k and IRA. Like I explained in my last video, a 401k lets you take out a portion of your salary and keep it in a box and tell the government that, hey, I'm not going to pay you taxes on this portion of the salary because I am not going to take that salary today, but I'm going to earmark it for my retirement. So I'll pay the taxes on that salary where I actually withdraw that salary from that account. And I want to invest it, and I'll make some more returns off of that salary. And when I take those returns out along with the original salary component, I will pay tax on the entire amount to the government at that point of time, which will be after 59 and a half years of age. So while a 401k is done through your employer, an IRA works exactly the same in terms of tax treatment as a 401k does. But this is something that you can do yourself by just going to a bank and opening an IRA account. So while a 401k is set through your employer, and employer will set a certain amount that you specify be invested every paycheck into your 401k, An IRA is something that would not be done through your employer, and your employer has nothing to do with your IRA. It's something that you, just like your savings or a current account or a CD, you can open it with any of the providers or bank that offer an IRA. An IRA stands for an individual retirement account, and that's exactly what it means. It's up to the individual, and they can go to any bank and open it up. But as far as the tax treatment for an IRA is concerned, it's exactly the same as 401ks, which means you take pre-tax money, you invest it, and you grow like you make money off of it, you make returns off of it for over a number of years. And when you're 59 and a half years of age, then you can start taking contributions or withdrawals from that IRA, and you have to pay tax on the entire amount that you withdraw from that IRA to the government when you do so in retirement. So in effect, an IRA works exactly like a 401k, except for two differences. Number one, an IRA is done individually and not through your employer. Number two, IRA has a limit of $6,000 per year per person, whereas a 401k has a way higher limit of $19,500 per year per individual. Well, now you might be thinking, if IRA is something I need to do myself, and IRA has a much lower limit in terms of how much tax I can save per year, why would I do an IRA and why don't I just stick to 401ks? Well, there could be multiple reasons. One could be that you want to take advantage of more than $19,500, which is the limit of on how much you can invest in a 401k. So depending on your total annual income, you may be eligible to actually invest pre-tax dollars into both of these options. Second, and the more important reason why IRAs are popular are because IRAs typically offer a wider range of investment options for your money than a 401k would. So if you log into your 401k account, you'll see a bunch of funds. They would range from very safe bond-based funds all the way to international equities, real estate, and REIT funds, for example. So the risk profile is a wide range, but typically you would find about 20 or 30 odd funds that are available for you through investment through a 401k. However, in an IRA, you could also actually invest in specific stocks or ETFs or bonds if you want to. Now, it's your personal option, it's your personal choice whether you want to invest your retirement savings in a specific stock, which would ratchet up your risk a little bit more, because if you're investing in a fund, you're investing in a group of stocks. So if one company goes down under, goes bankrupt, you're not really essentially losing all of your money. If you do invest in a specific stock, then you're investing in that specific company. And if something were to happen to that company, which is more likely than something happening to a bunch of companies that are in a fund, that's definitely a higher risk that you would be taking with your retirement savings. Now, whether you want to do that with your 401k is totally up to you, and you can even do it to a part. You can even invest in a specific stock for using only part of your 401k funds. Another reason why some people may want to do an IRA is for the simple fact that they don't have an employer, or they have an employer who does not offer 401ks, or the 401k options that they have are very, very limited in terms of the investment, which is not the case for most of the employees, I would say. However, that could be a reason why you would want to do an IRA, which lets you set these up on your own. Now, remember, in an IRA, you can only invest up to $6,000 per year, whereas in a 401k, you could go up as high as $19,500 per year, and both of them offer the same kind of tax advantages overall. Additionally, depending on what is your annual income and what kind of tax profile you have, you may or may not be able to take deductions on both your 401k and your IRA in the same tax year. So don't watch this video and go and directly invest in an IRA without doing your own research of what your income level is and whether or not an IRA would allow you to deduct that amount from your taxes. I would certainly say consult your financial or your tax advisor, or do your own research before going ahead and opening an IRA. So bottom line, here's what you can do about an IRA, if anything at all. First, find out if you would be able to take a tax deduction if you were to do an IRA for any amount of your money. If your income is above a certain limit, then IRAs will not be an option for you. If you are able to take a tax deduction on an IRA, and if you are interested in investing your retirement savings into a specific stock or a bond or an ETF, then figure out how much money you want to put in the specific stock and do that through an IRA for your retirement. And then whatever amount you're comfortable with. You can put your 401k, which you will be investing in one of the several funds that are available in your 401k, depending on what kind of risk you're comfortable with taking. If you are happy with investing your retirement savings in any of the funds that are offered through your 401k, and you're not looking to invest in a specific stock or ETF or a bond, then the 401k is the best option for you, and you can stick to that for up to $19,500 of your salary, which is a pretty high amount. Now that I've talked about both 401ks and IRAs, and you understand the differences between the two, let's talk about the Roth versions of both of these. Just like we have a 401k and an IRA, you have a Roth 401k and a Roth IRA, and they are completely different from the traditional 401k and the traditional IRA, as they are called. While a traditional 401k and a traditional IRA let you avoid paying tax on an amount of your salary today and invest it and pay taxes on all of that amount after you retire, the Roth 401k and the Roth IRA are the exact opposite of that, in the sense that in the Roth IRA and the Roth 401k, you pay the taxes on the salary today and you invest it in these tax advantage special investment options, and you do not pay taxes on when you take this money out for your retirement expenses after you retire. And the important distinction here is these options essentially let you invest your post-tax money, just like your other normal money that you use to buy stuff with. They let you invest that money in special places where you don't have to pay any taxes when they mature and when you take funds out of those. Or you take returns out of those, but you have to do so only after your retirement age of 59 and a half years old. So Roth 401ks and Roth IRAs are like any of your other general investments that you can think of, with two important differences. One is that your returns are not taxed, whereas in a normal investment that you do in a CD, for example, your returns will be taxed. And the second difference is that you can only withdraw money from these options after your retirement. So in traditional Roth and traditional 401k, you avoid tax today and pay tax after retirement. In a Roth IRA and a Roth 401k, you pay all the taxes today and avoid taxes after retirement. Both traditional and Roth are great options to save for retirement and make more money because of the tax advantages both of them bring. However, both of them have limits to how much you can invest in each of those every year. The 401ks have a limit of 19,500 combined. So the total amount that you invest in a traditional 401k and a Roth 401k in one financial or a tax year cannot exceed 19,500. Similarly, the IRAs have a combined limit of $6,000 as of the date of this video. So the combined amount that you invest in a traditional IRA and a Roth IRA cannot exceed $6,000 for an individual. Now, in a traditional IRA and a traditional 401k, you are sort of taking a risk because you don't know what the tax rate is going to be when you retire. However, that risk is entirely eliminated in a Roth IRA, where you're essentially paying the tax at the tax rates today, which you already know, and then you're guaranteeing tax-free money during your retirement phase. Now you might be thinking, if a Roth entirely eliminates the risk that the tax rate might go up in the future, why don't I just do a Roth IRA and a Roth 401k? Why should I even think about doing a traditional one? Well, we will get into that in a bit when we go and do a short demo of how the numbers and the dollars look like into a traditional when you invest through a traditional 401k versus a Roth 401k. So in my last video, we saw how investing through a 401k would net you more money in the long run than if you invest outside of a 401k. In this video, we'll throw in Roth options into the mix and see how that sort of changes the tax treatment as well as the dynamic, and would you really end up with more money by using a Roth 401k versus a traditional 401k. And the same kind of argument would apply to a Roth IRA versus a traditional IRA as well, because the tax treatments for traditional options are similar and the Roth options are similar. It's just that the only difference between the 401ks and the IRAs are the limits, but essentially the tax treatment wise it would be the same. So your the impact on the amount of money that you'd make or save over the course of years for your retirement is going to be exactly the same. So let's get right into it. So let's start with $1,000, for instance, and build a quick model to show how that same amount of money invested through three different options, what returns you would yield in each of those scenarios. So the first scenario would be a normal investment options, not considering a 401k or an IRA. Second option would be a traditional IRA, and the third option or third scenario would be a Roth IRA. Let's say we are starting with a salary of $1,000. And this is, let's say this is pre-tax salary of $1,000. So this is the gross amount that you see in your paycheck, which is the top line of what you actually get paid by your employer. Let's say your current tax rate. So today's average tax rate for you, let's say this is 30% as of now. So out of the $1,000 that your employer paid you, you'll pay 30% of that as a tax. And let's just consider this is federal tax for now, and let's keep state taxes and all of those tax complications out. For the sake of simplicity, let's just assume you're paying 30% to the government today on the $1,000 that you made. So what you get in hand, which is your post-tax salary, is basically $700. So 30% of 1,000 is $300, which you pay as tax, and what remains, what you get in hand in your bank account, is $700. Now, if you were to invest these $700 outside of a 401k, outside of an IRA, that's what you would invest. Let's say that's the first scenario. No 401k. And the second scenario is going to be a traditional 401k. And let's say the third scenario we want to see is a Roth 401k. So what would happen in a no 401k scenario is basically you will pay tax on that $1,000 and you will get $700. Let's say you invest that $700 in some sort of investment option. And let's assume that this is an index fund, for example. Okay, so rate of return. And let's assume that this investment option gives you an annual rate of return of 7%, which is kind of the average return of an index fund over the past several years or decades, accounting for inflation. So let's just use that as our rate of return every year. So this is year 0 is when you invested this amount. What would happen in the next year, in year 1, if you're getting a 7% rate of return on that, the balance at the end of year 1 is going to be simply the balance that you started with multiplied by 1 plus your rate of return. So that will be $749. So you made $49 in the first year when you invested in an index fund, this amount of $700 to begin with. So let's say we are about 20 years away from retirement. So I'm just going to stretch this out to year 20. And now we can simply anchor the rate over here in Excel and drag this formula all the way to year 20 to see what balance after the end of each year. So year 2 you'll have $800, year 3 you'll have $858, and so on. And here you can see the interest is compounded every year. So the first year you make 7% on your 700. The second year you make 7% not only on that 700 but also the $49 that you made in the first year. So you make 7% of this full amount, and so on and so forth, till your end of year 20 balance is coming out to be 2709. So the 700 that you invested after 20 years of compounding at 7% interest, it has grown to almost 4 times that amount. Now let's say at year 20 I'm going to take this entire amount, and year 21 for example I'm going to take this entire amount out for my retirement, my day-to-day expenses. When I do take this withdrawal from my normal investment account, I will need to pay taxes on the returns that I've made off of the $700. So I've already paid the taxes on my salary, and that's how I ended up with 700. So I don't need to pay taxes on the 700 amount, but I do need to pay taxes on all the money that I made on top of the 700. So which is basically the profits or returns that I made over 20 years is simply the 2709 minus my original investment, and that's $2,000. I'll be paying a tax paid at withdrawal. This is going to be my tax rate multiplied by the returns. So that's about $600. Now, if you notice, I use the current tax rate for this purpose. Now, that's one of the unknowns. I don't know if this tax rate is going to stay the same after 20 years. So what I'm going to do is I'm just going to put a different assumption here. Post retirement average tax rate. Now for right now, let's just assume that tax rate is the same as our current tax rate. So in which case you'd still be paying 30% of that. And I'm going to, instead of using the current tax rate, I'm going to use the post retirement tax rate. It'll be the same amount because I'm still assuming it's 30%. So money in hand at retirement is simply going to be my total balance here minus what I paid as taxes, and that's this amount over here, 2106. So now let's build out the same scenario for a traditional 401k scenario. So if I were to invest, instead of paying taxes and then investing on my own, if I were to invest that $1,000 in a traditional 401k, then I get to invest that full amount in the traditional 401k. Because remember, in a 401k, what essentially I am allowing myself to do is not pay taxes on the amount today, invest it, grow, and pay taxes later after retirement. So I'll be investing the full $1,000 in the year zero. And let's assume I'm using the same investment option that pays me 7% a year, year after year for the next 20 years. And we'll go into what those investment options could look like in a bit here, but I'm going to assume that I have the same investment option over here. So now what I do is I put the $1,000 and plus 7% of that is $70. That's what I have incrementally at the end of first year, and I will just carry over that formula year after year. Every year the interest will compound based on the end of the year balances, and I will have $3,870 at the end of year 20. So the $1,000 has also pretty much quadrupled, well, close to that at the end of year 20. Now, what are the profits over here? Well, it's simply the same formula, which is my end of the year 20 balance minus my original investment. Those are my total cumulative profits. So as you can see, I made some more profits here because I had $300 extra to begin with, and that explains for that the difference in these two over here. And now the tax that I'll pay on the withdrawal. Now remember, for a 401k, I'm going to pay the tax for the entire amount because I have not paid taxes on these 1,000 either. So when I'm going to again assume that I'm going to take the full withdrawal, which is the 3870 in my year 21 when I retire, and I will have to pay a tax of whatever my tax rate is at retirement into this full amount, and including the $1,000 from the beginning. So that's going to come to 1,161. Now, at first glance, it may look like, wow, I'm paying almost $500 to $600 more in taxes in this case. However, if you look at money in hand, which is basically the total balance minus the taxes that I pay, you can easily see that I will have more money in hand if I were to take the 401k route versus investing on my own after paying taxes. Now, where does this difference come from? I've explained this in my previous video, but I'll do it again real quick. This difference really comes from the $300 that you did not pay to the government in year zero, and you basically made money off of that $300 over the course of 20 years. And at the end of year 20, you paid the government only 30% of that money that you made off of that $300, and you kept the 70% to yourself. And that basically accounts for the difference between these two numbers. Now let's build out the third scenario, which is a Roth 401k. So in a Roth 401k, it's completely the opposite of a traditional 401k in terms of the tax treatment, which essentially means I'm going to invest post-tax dollars into this. So I'm going to pay the taxes on the $1,000 today, which is 30% of that, which is $300, and I will only have $700 to invest in a Roth 401k. And now I will basically grow this money at the same annual interest rate, which is 7%. And these numbers are going to look exactly the same as the new 401k option over here. However, a Roth 401k is a special account which lets me take these contributions at retirement without any tax levied on them. So basically, my profits are going to be the same. It's 2709 minus my original investment, and tax paid at withdrawal is going to be zilch. So that is big zero there, and I will end up with all of this money in hand.
So now you can see a traditional 401k and a Roth 401k both are paying me the same exact amount of money when I retire in hand after tax treatment is applied already. So what's the benefit of one versus the other? So the key to that question is a very important assumption that we have in this model right now, which is that today's tax rate for you is going to be the same as your post-retirement tax rate. That assumption may not always be true. In most scenarios, your post-retirement tax rate on this money that you would be withdrawing from your retirement accounts is going to be lower than what they'll be taxed at today, because right now you're making a lot of money with your job and your investments, and you would generally, most people would fall into a higher tax bracket when they're working than when they retire. So if the average tax rate post retirement, let's say, goes down to 20%, then you can see how the model changes and how you would end up with more money in your hand. If you do a traditional 401k, you see the numbers has already changed. You have close to $300 more over here over $1,000 initial investment. If you think for some reason in the future the tax rate, the average tax rate for you after retirement is going to be higher than your current tax rate, let's say this worst case, this goes up to 50%, then you can see how doing a Roth 401k would benefit you, because you are paying the taxes on the original amount and your returns are not at all taxed in a Roth 401k. So you're basically guaranteeing this tax-free money after retirement, and you don't have to worry about what happens to the tax rates 20 years down the line, what does Congress do, and so on and so forth. So if you want that sort of peace of mind, and I don't want to care about what the tax rate is going to be 20 years down the line or 30 years down the line, depending on when you retire, whether it's going to go up or down, I don't want to worry about that. Roth options would overall be a better option for you.
So if you like this video, please like, share, and subscribe. Thank you for watching.
Take